Good morning, traders. If you're in the US or America's time zone, if you're in Europe, good afternoon. And to our traders in Asia, you're moving into your evening. So, good evening. Welcome to our daily webinar. This is James with you today, standing in for Steve. It is January, Thursday, the 13th, 2022. And boy, what a start to the year it has been. Kind of reminds me of the Red Wedding episode of Game of Thrones. Certainly, when I look at my trading and some of our traders' start to the year, we could term this month Red January. For that reason, I want to change the format of this daily meeting for today. And rather than jump straight into a recap and outlook, I just want to spend a few minutes sharing some thoughts and insights that I have on trading with you to hopefully, I guess, impart some knowledge and just hopefully give you a sense that you're not alone and some tools that you can use right now to help you recover if you're having a bad January. So the first thing I want to look at is the month itself. Now, my professional full-time trading career was 15 years, and I've been trading sort of kind of part-time since I retired, or semi-retired, I should say, in 2009 from full-time trading. Just so for those that you don't know, after 2009, I went on to work for an exchange and then managed trading groups, prop trading groups around the world. So through those jobs, I didn't have the ability to trade full time, but I would always keep my hand in the markets. And then in the last few years, I've been a little bit more active every day, but I don't consider myself a full time professional trader now. But up until 2009, I'd been trading about 15 years full time professionally. And I would say statistically, January was my worst month. Now, it's hard to really pin without looking at the data going back. But I would say maybe 10 out of the 15 years that I traded, January was my worst month. And I don't really have a solid answer why. I just have some thoughts on why it potentially was my worst month. But interestingly, when I went on to manage traders and run large trading teams around the world, I saw this phenomenon, this first month to the new year. Um, Happening with other traders, not every trader. So if you've been doing well this year so far, and there are a few of you who have, well done. But we have seen a lot of our traders struggle this month, and part of that is down to the volatility in the market, which I'll come on to in a moment. But also part of it, I think, is down to what I call the January mindset and how we have to be aware of it. Now, what do I mean by the January mindset? Well, typically, there is a shift in your psychology as you come into January, and that can have a significant impact on your P&L. But what causes this shift? Now, what I think happens is as we run into December last year or December of the previous years, the markets tend to go quiet. You tend to slow down your trading. You're looking forward to the holidays. Some of you take advantage of the low volatility that we typically see in December and the fact that the markets are closed during the holiday period to book a holiday and go on holiday and step away from the markets for a couple of weeks. And then what happens typically during this time period, whether you're on holiday or at home, is we start to think about the year ahead. And we start to say to ourselves, right, I want a really good year coming up. So, let's look at 2021, December 2021. We could have been sitting at home thinking to ourselves, right, 2022 is going to be my year. It's going to be my year to make a ton of money trading. I'm really going to work hard. I'm really going to come back. I'm going to take it seriously. If I'm on the evaluation challenge, perhaps I really want to pass the evaluation challenge so I can get funded. And if you're funded, you might be thinking, right, now is the time to really up my trading and scale my trading. And, and you really sort of gear yourself up for what I think, or gear yourself up to have you come into January with this like kind of aggressive approach to the markets, right? You start to think differently and trade differently to how you were trading before, because you're looking for opportunities that aren't necessarily there. You're overly aggressive in your trading. You're pushing your trading. Can you see you're slightly changing the way you trade, and that starts to impact your P&L. The other thing is as well, if you've taken time off, you're likely to be out of what we call sync with the markets. You know, you're not used to how they're moving and how they're moving around. And of course, as we've come into this January, we've experienced a spike in volatility, which I'll come on to in a moment. But that going hand in hand with you being out of sync and not really, having been trading regularly and consistently for, let's say, the past sort of 3-4 weeks, having taken that break, you're setting yourself up for failure. It's this shift in psychology, wanting to be more aggressive, wanting to take more money out the markets, wanting to push yourself when the markets aren't necessarily there, when you're not necessarily ready. This change in psychology, this switch to being more aggressive that, we may not actually consciously mean, but by sitting and trying and saying to ourselves at the end of December, right, I want a really good year. I want to get started. I want to, show them I can make money. I want to show my wife or my partner, or, my friends or my parents that, I'm not wasting my time trading. I want to be a good trader. Then that shift in your psychology can shift the way that you look at the markets, the way you interact with the markets, and that impacts your P&L significantly. So think about that. Think about your January mindset. There is also a situation sometimes, I haven't actually got it on this page, where I think that the markets in January, certainly in the start of January, can appear to be busier than they actually are. And what I mean by that is there is a lot more, I think, day trading going on in January for the exact reasons that I've just laid out. A lot of people keen to come back, keen to get going, keen to make an impact, and that compounds on top of each other, causing these quick sort of like what I think are light volume or can be light volume moves. I mean, we've seen market volatility for different reasons. Again, I'll come on to that in a moment. But there is one sort of phenomenon that I think that we should be cognizant of, and that is that big bank traders and large hedge fund traders and real asset managers, the people who are moving the market, setting the trend, and what we call the paper money or real money in the markets. Day traders are known as the fast money, but the real money traders, they are not necessarily involved at the moment. Most or a lot of these traders have their annual bonus decided on usually their year end, which might be the end of December. But that bonus isn't normally paid until the end of January or going into February. And so if you've got any friends in investment banks, ask them about this phenomenon. The bonus is based usually on the last year's trading, but it's not paid until the end of January or February. And I think what might happen is that a lot of these traders, not a lot, but some of these traders will be thinking to themselves, I don't want to risk my bonus. I had a good year last year. So I'm not going to do anything wild or put on any big positions in January that might undermine the decision made by my managers prior to them handing over my bonus check. So we actually tend to see, a great deal of paper come into the markets in the first week or so in January, as traders sort of sit back, also assessing, okay, it's a new year, it's a new market. What are the Fed going to do? What's the ECB going to do? What are the central bankers around the world going to do? What is inflation? What does employment look like? And then start to think about putting on their long-term trades when they've got that data in their pockets. And of course, that data doesn't start to roll in until halfway through January. So the third part of this equation then is the increase in volatility. Now, there's no doubt we have seen an increase in volatility, and we've seen some spikes in volume. So there are people coming in. There might be some profit taking from last year being taken off the table as well. Um, all around inflation, which we'll come on to when we take a look at the recap and outlook part of this meeting. But I just want to talk about how to handle this increase in volatility. The volatility is different to what you've been used to. Okay, in December, the markets, we had some moves in December, but as the last 2, 3 weeks in December, things are relatively stable. We tried to test new highs, we fell back. It looked like it might start to sort of enter a bit of a sell off. It didn't, it stalled, and it kind of just found itself in a range. Fast forward now to the last week or so of markets, and we've seen a huge spike in volatility. You're not used to this volatility. It takes time to get in sync with this volatility. One of the biggest mistakes we see traders make is an increase in aggression because the markets are volatile. Sometimes an increase in size because the trader thinks, wow, these are big moves. If I get this right in size, I'm going to make a lot of money. That's their natural instinct. Certainly for some traders and certainly for new traders, the actual right thing to do is to reduce your size. Reduce your size until you become accustomed to the volatility. Reduce your size because the trading opportunities are big, and we need to be able to stay in our trades longer because the increase in volatility means our stop levels get tested more. So, we might be a bit looser with our stops in order to do that and make sure we don't breach our daily risk limits. We need to trade small. I would highly, highly recommend a switch to micros on these busy days, and certainly a switch to micro contracts when when you've been losing money. Now, one of the things that we hear a lot is a pushback against reducing your size or trading micro contracts, particularly when you've had a few days of losses. The first thing that people say to us, traders say to us, is, how am I going to make my losses back with small size? And what you have to know is that it is not about making your losses back. Let me repeat that. It's not about recovering your P&L and making your losses back when you've sustained a few days of losses, particularly significant losses. It's about getting your trading confidence back. How do you get your trading confidence back? You need to put a few winning days together. Now, reducing your size does a couple of things. The first thing it does, it reduces the pressure on you. If you continue to trade badly and continue to lose money, then it's not really going to hurt you financially because you're trading much smaller size. If you're a 10 lot trader, go to a 1 lot trader. If you're a 1 lot trader, go to one micro contract. You're not in, and if you continue to lose, it's not really going to impact your P&L, your overall P&L too much. But and for that reason, it reduces the pressure on you. But once you start to make a few trades, what's going to happen is, no, you're not going to make big P&L, but you're going to make your confidence back. It's going to help your confidence as a trader recover. And that's the first step in becoming in sync with the markets, in sync with your trading, and beginning to sort of get your size back up, and then start to make your money back. Right. So if you're on a period of sustained losses, you're in January, it's red January for you, you're licking your wounds. Don't concentrate on your P&L. Don't concentrate on trying to recover the losses. Concentrate on getting your confidence back. Trade small, trade infrequently, look for high probability opportunities, Put a few winning days together trading small, and the world will look like a different place for you. You'll soon be ready to go back to your regular size, and that's when you'll be able to recover your trading losses. So in summary, if you're having a rough ride, focus on capital preservation, not recovering your P&L. Trade small until you are in sync with the markets, get your confidence back, and recalibrate any expectations you had for January. Right? This doesn't have to be your best month. This doesn't have to be the best start to the year. This doesn't have to be, I show you markets I can trade, or I show you people I can trade. This is just another month that we have to work through. Always been a very difficult month for me trading. I suspect it's the same for some of you out there. I certainly know, overseeing our trading book here at Trade Day, that a few traders who normally are pretty consistent have had a tough start. And my experience of managing traders around the world in the last 10 years, I know this January phenomenon is real, and it impacts people. So good luck handling that. That was just my thoughts for the trading day. And right now, I want to shift back to our regular format of our daily overnight recap of what's been going on in the markets, and then and have a look at the day ahead. So on Thursday, let me just pull up the daily calendar here. Right. So it's Thursday today. A couple of days ago, we saw a pause in the sell-off. What caused that? So the first thing is the Fed Reserve Chair, Jerome Powell, and he sought to really reassure lawmakers and investors on Tuesday that the central bank can pull off this tricky task of bringing down like four decade high inflation without damaging the US economy. And that brought a sense of calm, or a sort of, I don't want to say sense of calm to the markets, but it gave us the opportunity to catch our breath. All right, the market sort of paused, stopped the sell-off, and yesterday we saw a little bit of volatility. Interestingly, yesterday we had the monthly key inflation data, which is probably the most important data right now that's being released every month. It was the CPI, and it came in higher. Year on year CPI is 7%, but the market, didn't sell off, at least not initially. There's a little bit of volatility around the number, a little bit of a bid after the number. Some people might say, why is that? Inflation went from 6.8% to 7%. The reason is the forecast for that number was 7%. So the expectation going in amongst the traders, and therefore what's been priced into the market, is that the expectation will be 7%. And when the data was released, it met expectations. It wasn't a surprise. So, new traders know that the market reflects what we are expecting as investors, regardless of what actually happens in the data. So the data was 6.8%. It went up to 7%, which is worse, but the markets didn't sell off because there was an expectation that it was going to come in at 7. In fact, if it had come in at 6.8, that would have been a slightly positive sign, because it would have beat our forecasts and expectations. So that was yesterday. Sort of kind of like a choppy day, a little bit choppy day, a little bit softness towards the end of the day. One thing I've been watching actually is crypto. Not that we trade crypto at Trade Day, but it's been interesting to see the crypto sort of softening of that market and the sell-off. And I think it's really highly correlated to the stock indexes, and essentially it's asserting itself at the moment as a risk on, risk off. A risk on, it moves a risk on and risk off sentiment. There is talk, or there has been a lot of talk in the crypto community, and some investors, that Bitcoin is a great, and cryptocurrencies are a great hedge against inflation. We don't see that, if you just look at what's happened in the last few weeks, in the last month or so, inflation's been become more and more of a concern in the economy, yet crypto's been selling off pretty consistently since its highs. I can't remember where Bitcoin was, around sort of 65,000, was it, as an all-time high for the last few months. So it's not a hedge against inflation, and the increase in the CPI yesterday from 6.8% to 7%. Some people are saying, "Oh, that's why Bitcoin rallied." No, that's not why Bitcoin rallied. As we said, 7% was expected. Stocks, firmed up. The market's taking a breather, and that's because there's a little bit of the stopping of the risk off, and more just very slightly risk on, and that just caused Bitcoin to hold in around 40 and then rally up to about $44,000. So that's what I see Bitcoin doing at the moment. It's really just moving in sync with stocks. Risk on, Bitcoin and crypto goes up. Risk off, Bitcoin and crypto. The rest of crypto goes down. So that's just one thing I wanted to point out. Oil, my word, I can't believe it's so high. I mean, we had the geopolitical tensions with Russia. That's part of the issue here. There is also a report from the EIA that showed global oil stockpiles will decline slightly in the first quarter of this year compared to a previous forecast of an expansion. And reassurances yesterday from Oman's oil minister that OPEC do not want to see oil $100 a barrel, did little to calm investors, and are becoming, and I think just investors are becoming increasingly doubtful about the cartel's ability to reach output goals. So we have that, and we have also the US, a US contingency. Diplomatic contingency, and a economic contingency working, economic policy body working on contingency options in case President Vladimir Putin decides to cut energy supplies to Europe in response to Western nations pressing back on an invasion of Ukraine. When we found out that the US was working on these contingency plans, oil did sell off on that news. But I can't really see oil doing a great deal. I'm just having a look through now at. I can't see oil doing a great deal at the moment unless there is, some significant sort of breaking news now to drive prices south. It seems very, very firm at the moment. Obviously, we are high. I think we're on. I can't remember actually. Maybe highs since 2011. Does that sound right? I'm just trying to think. It is very, very, very toppy at the moment, which means we can get sudden sharp sell-offs in oil, but I think the overall trend in oil is still firm. So watch out. I've been caught going short in oil the last sort of few weeks, a couple of times. Just because I've got this natural bias in me to go short while it's at these highs, and I'm trying to fight that. But in the absence of any sort of news to drive it lower, I can see oil sort of sitting around these levels for this foreseeable future. What else have we got to talk about this morning? Let's have a look at the headlines. There's actually not much in the way of breaking news headlines. The latest market news on Reuters is stabilization signs emerge after inflation palpitations. This is just the talk of yesterday, really following on from the US stabilization with CPI coming in as expected. And the Fed chair on Tuesday saying, just basically reassuring the markets. And so we've seen some sort of stabilization of indexes in Europe. In fact, where are we? Yeah, so in overnight, it's been a subdued session with the MSCI Asian Pacific broadly unchanged. Japanese Topics Index just closed down 0.7, and the European Stock 600, as of a couple of hours ago, was less than 0.1% lower. So kind of a sort of a quiet-ish session in Europe. As I said, I think the markets are just taking a breather. We're waiting to see what happens. certainly going on from Thursday's Chairman Powell, what we're looking at now is focusing on the other Fed speakers. Overnight, President Mary Daly and Patrick Harker said they support a March hike. So the market's now pricing in a 90% chance of a March hike. But remember, the Fed will need a consensus to move on rates. So it's really important that we watch what the members of the Federal Open Market Committee are saying in the press. And today is a confirmation hearing of Laurel Brainard, I believe it is. And she has already released a pre-prepared speech talking about tackling inflation is the bank's most important task. So she's, hawkish on inflation, but we'll watch that confirmation hearing to see if there's any additional color that she wants to give or any indication that will be voting or leaning, let's say, towards a March rate hike. On the subject of Fed speakers, I wonder if it's in the calendar. We've got FOMC member Bernard speaks today. That's Laura. That's the lady we just talked about, Laurel Brainard. She's I think, is it Brainard? She's going for her confirmation hearing, but there are a couple of other Fed speakers. So you've got ECB speakers as well for those trading European markets. Watch out for their comments, if any, on inflation. Chicago Fed Charles Evans and Richmond Fed Thomas Barkin also speak today. So interesting to hear what they have to say. Keep an eye out for that. On the data front, it is a relatively light day, other than core core PPI, producer price index, which is an inflationary reading, and that's out in 18 minutes. So 7:30 Chicago time, 8:30 New York time, and 1:30 p.m. for GMT. So weekly jobless claims. The investing calendar always marks that a 3 ball in terms of importance. We watch it. It's not that important, to be honest. More important will be the PPI. And that's it really on the data front, as we can see today. So a relatively quiet day on the data front. All eyes to Fed speakers, see what they have to say. We are also moving into earnings season as we go into the next week. So this will be the earnings for the last quarter of 2021. That will be driving the stock markets in the coming weeks. So let's keep an eye on those news stories, and we'll be covering them as they happen. Just seems there's anything else. There's a little bit of talk about the dollar weakness that's been happening in the last few weeks. This article on the Aussie dollar showing a rebound here of the Aussie dollar and strength in the dollar, and crossing this moving average. Talks from a technical standpoint that there is strength in the Aussie dollar. I think it's more broader US dollar weakness as the deficit looks to widen. And I read an article about global investors seeing sort of quicker recoveries and stronger recoveries in economies outside the US than the US. So, you'll see a selling of US dollar and a buying of those economy currencies. Again, we had a sort of a risk on day yesterday. I wouldn't say it's a risk on, but a pause, which probably aided this, continuation of the strength of these non-US currencies and the weakness of the US dollar. But, I'm not really watching the US dollar at the moment. My eyes are on inflation, on the stock indexes, and on oil. I think that about wraps it up for the day. We've covered the data, covered the overnight news. I'm just looking through my notes. Omicron's not so much in the news at the moment. It's not so important in terms of driving price, but the New York Times this morning is leading with the number of new COVID-19 cases in New York City rose more than 20-fold in December, but in the last few days, it has flattened. And in New Jersey and Maryland, new cases have fallen slightly. So it's basically the sentiment of the article is that we might be plateauing. Now, of course, the COVID-19 and its variants has been an ongoing story that continues to surprise us and continues to surprise the markets. But with Omicron, it might seem now in the US that we are turning a corner. Certainly in Britain, where pandemic trends have frequently been a few weeks ahead of those in the US, cases peaked just after the new year. So Omicron seems to be becoming less of a concern for us. Inflation remains the focus. And if you're day trading, remember Red January. Let's figure out how we're going to handle this together. I'm going to throw these thoughts into our activity feed for our members, so you can, take your time reading them and really try and process them. Remember, being a good trader is as much about your psychology and the ability to sort of like internalize and recognize what's going on inside you and trade accordingly, as it is understanding the markets. So I'm going to leave it there. I'm going to wish you good luck today. It's great doing today's meeting. I enjoy the opportunities to do these and wish you all a great trading day. Good luck.